While the rest of the stock market is getting absolutely crushed, one company has been on fire. This company is run by investing legend Warren Buffett and is none other than Berkshire Hathaway. While the rest of the market is down 15 to 20% this year, Berkshire Hathaway is up a staggering 16% in the first couple months of 2025. This is nothing new for Berkshire Hathaway though, because over the past 20 years, the S&P 500 is up about 363%, and Berkshire Hathaway is up 854% in that same time span. And Berkshire isn't just crushing it and going up, it also has downside protection during a bad or during a down market so that it actually keeps you safer than the overall market. You can see here that it rarely goes negative for the year even when everything else does, especially here in 2022 when the S&P 500 dropped a massive 18%. Berkshire actually ended the year up 2% and was one of the only companies to do so. I believe that Berkshire Hathaway is going to beat the overall market for a couple of key reasons, including the fact that it's actually very tariff resistant, which is so important right now in 2025. So I'm going to clue you into some of my research and show you why this is one of my top individual stocks in my portfolio. My name's Nolan Govea, my students call me Professor G, and I made this channel to make investing simplified. Now, Berkshire Hathaway has been expertly engineered by Warren Buffett over many years. Buffett's one of the people that I studied most during all of my academic studies, but also for my own investing, and even made this channel based off of most of his teachings. He's known for keeping things simple and staying straight to the point. Berkshire's massive $334 billion in cash is at the core of this stronghold, cushioning the conglomerate while supporting the possibility of opportunistic acquisitions. In the meantime, its portfolio includes defensive businesses from Geico to Coca-Cola, further positioning it to endure both short-term and long-term challenges. One big reason why I believe that this company is up so much is not just because it has a cash pile and that cash pile provides some stability in the company, but also cash gives Warren Buffett opportunity. By mid-May, Berkshire Hathaway will have some answers to questions about whether Buffett found opportunities to deploy some of this cash during the market's worst quarter since 2022, which was this first quarter in 2024. The company will file its quarterly report ahead of its May 3rd shareholder meeting, and Berkshire is required to file its Form 13F with the SEC by May 15th. So as of right now, we don't know if Warren Buffett's still sitting on all that crazy amount of cash that he was sitting on in Q4 of 2024. We don't know if he's decided to use some of that in those massive dips that we saw early in 2025. $334 billion invested during a dip and receiving cheap prices on very solid businesses is Warren's favorite thing. Notably, the last spending spree that Berkshire went on and bought a little bit into certain companies in Q4 of 2024 was actually quite minimal, because he was mostly keeping that cash off to the side and waiting for this eventual dip. In Q4 of 2024, he bought Occidental Petroleum, about $409 million worth, VeriSign for about $90 million worth, SiriusXM for $296.8 million, Pool Corp, estimated at about $70 million, Domino's Pizza, estimated at $470 million, and Constellation Brands, estimated at $1.3 billion. The move that I really liked that he did that didn't get as much attention until you dived in a little bit deeper was that he actually added to these Japanese companies that actually look very solid. The 94-year-old investor's Berkshire Hathaway Holding Company raised its holding in 5 Japanese trading houses. And I'm sorry if I get these pronunciation wrong. Itochu, Marubeni, Mitsubishi, Mitsui, and Sumitomo by more than 1% point in each, to stakes ranging from 8.5 to 9.8% according to a regulatory filing. At the end of 2024, the market value of Berkshire's Japanese holdings came to $23.5 billion at an aggregate cost of $13.8 billion. Which basically means that Warren Buffett found some diamonds in the rough. He's paid so far around $13.8 billion into these companies, and at this point they're worth $10 billion more than what he put into it. They've almost doubled, which is just crazy. Warren Buffett praised the company's management, relationships with their investors, and their capital deployment strategies. Knowing that investors are getting a little bit anxious, for Warren Buffett to start using some of that cash that's just sitting off to the side, he actually had this to say to keep everyone and their anxiety down. Berkshire shareholders can rest assured that we will forever deploy a substantial majority of their money in equities, mostly American equities, although many of these will have international operations of significance. Berkshire will never prefer ownership of cash equivalent assets over the ownership of good businesses, whether controlled or only partially owned. So he's saying that he wants to, and definitely will be, investing the bulk of that money into companies to make it grow, just like it's been doing for all these years. He's not sitting on cash and bonds because he prefers to sit in cash and bonds, or he's just sitting this out and now he's just collecting a paycheck off the interest. That's not what he's trying to do. He wants to deploy that money into companies, he wants to grow it. He's just been waiting for the right value. This should make the investor that's been invested in Berkshire Hathaway very excited. I know I am. Beyond that never-ending cash hoard, Berkshire's portfolio of public and private businesses is another pillar of its strength, as it's designed to withstand the worst downturns. The tariff-induced headwinds shouldn't be challenging to overcome either. Like Geico and BNSF Railway, its core holdings are quintessential defensive plays. As a leading auto insurer, Geico benefits from steady demand regardless of trade policies, as car insurance remains a non-negotiable expense for millions. In the meantime, BNSF makes for an irreplaceable American logistics asset. This is because the railroad giant transports essential goods across the US, a role that tariffs may disrupt but won't derail given its domestic focus. Historically, these businesses have generated consistent cash flows, shielding Berkshire from the volatility pounding more cyclical sectors, and this time should be no different. On the public side, Berkshire's stakes in companies like Coca-Cola and American Express further insulate it. Coca-Cola's global brand, essential product line, and locally based production effectively guarantees steady sales even as tariffs raise costs elsewhere. And then American Express, with its affluent customer base, thrives on resilient consumer spending among high earners who are less affected by the trade war fallout. Berkshire owns many companies and pieces of many companies within the conglomerate, but those were some of the big ones. I look forward to the filing in May where we get to see what Berkshire actually did with that money, and I think that they did something crazy. I think that he put in a good chunk of money during some of those monster dips that we've seen so far. I know there are some deals out there on some company that we're all overlooking, and it's just going to be a hidden gem, and because we're invested in Berkshire Hathaway, now we get to be invested in this hidden gem and we get to make money off of it. Buffett's always locked and loaded. He always knows exactly what company he wants to buy. He just sits and waits patiently till the price hits exactly his value for what he thinks it's worth. And I think the price was right during one of those really big dips. Berkshire Hathaway is trading around $526 today and has a market cap of over $1.1 trillion. That PE ratio of 12.76 is incredible, and the beta is a 0.8, meaning that it's less volatile than the S&P 500 and is a great source of stability for any portfolio. So basically, it's safer than the S&P 500. Less volatile means it drops less than what the S&P 500 would drop or the total US stock market would drop. So it gives you stability and safety in your portfolio, but also is growing higher than some of these things. Lately, a lot of my clients have really liked this strategy and this idea of kind of using that as one of the safer funds to balance out anything that's high tech in their portfolio. So something like a growth ETF or an AI ETF or these AI or growth stocks. You could balance that out by putting the safer Berkshire Hathaway in there. The other reason we like Berkshire Hathaway is because it doesn't pay a dividend at all. So if you're a higher income earner or if you're just worried about your tax bracket and you're investing in a taxable brokerage and you don't want that dividend income because you don't want to have to pay taxes on it, Berkshire Hathaway checks that box as well. I'm investing heavy in Berkshire Hathaway, BRK.B specifically. I wish that I had BRK.A, maybe one day, but I've definitely been investing heavy in Berkshire Hathaway ever since I started investing and continue to do so today. To see my full portfolio, check out this video here, or watch this video to keep you going strong in your investing journey. And remember to keep investing simplified.